So welcome everybody. So today, just want to kind of give you guys an opportunity to kind of ask questions. We really want this to kind of be a back and forth. Sitting here listening to me and Dan talk is probably not really what you guys want to hear. So we'll kind of run
the most
through.
Dangerous thing in here is the chairs.
There we go. I'm going to mute everybody.
No,
if you want to.
I got it, Charlie. I got it. You keep going.
Okay. Sorry, I lost my train of thought. Anyway, so we'll run through the composite book, give you guys an opportunity to ask questions. Please, if you have any, feedback or that kind of thing, Brent is monitoring the chat. If you want to throw questions up into the chat, I'm just going to kind of run through it a little bit, and we'll talk about kind of this year's numbers compared to previous. And kind of why these numbers are important to you as a business owner. So just some kind of things to consider as we get started here. It's good to compare yourself to other people. It's good to compare yourself to other businesses in different industries. It's also good to kind of compare yourself to other people within your own peer group. But really, we want to kind of make sure that we're not only making those comparisons, but looking to improve our own numbers, right? So kind of taking that into consideration as we go through. One of the other things to kind of think about as we go through this is kind of what stage of business that you're in. One of the things that we identify within peer groups is, are you a startup? Are you in the growth phase? Are you in a mature phase where, you've kind of been humming along it for a number of years? Or are you getting to that point where you're in a exit or a transition phase where maybe, you're looking to retire, or maybe there's the market is really gotten better and you're looking to sell your business. So just kind of taking that into account as we look through these numbers. The other thing to take into account is also, kind of the labor market where you're at, maybe the real estate costs in your area, population density, insurance costs. I'll use one example. We had a gentleman in one of my meetings here recently that his business moved from one zip code to another, and it had a significant increase on the amount of his insurance costs. And just, he didn't even move that far. It was just that change in zip code that adjusted his insurance costs. So just some kind of things to consider as we're going through this. Diving right in, overall performance. So this is kind of the top line stuff, right? So we're looking at top line revenue. As we go through these slides, I've kind of got all my slides kind of laid out the same. Equipment average and median, and then the event average and median. And then the shading is based on just kind of some anecdotal evidence compared to last year. So if it's red, it's gotten worse. If it's green, it's gotten better. And if it's yellow, it's kind of that neutral number. So just to kind of give you, kind of an idea of where we're at from that perspective. So Mark, did you have a question?
Yeah, I can't see anything. It says can't display presentation.
It might be your...
For some reason.
Yeah, let's see if you can go
Anybody up. Other externals, everybody see it? Anybody else not seeing it?
I can see it.
We see just fine.
Okay.
So everybody can see it but me.
Check your glasses, Mark.
Mark, the other thing you might try is leave the meeting and come back in. Sometimes.
Well, I was actually going to suggest. I was going to suggest he looks up at the top where it says "Change your view," because he might be in a view. He might be having a view issue, like what view he's in.
Oh yeah. All right, I'll keep. Hopefully, you can get it, Mark.
Go ahead.
Okay. Well, and I'm going to share this with you guys once we're done. I'll share it with you so that you have it.
Okay.
Okay. So you can see total revenue down on the equipment side, up on the event side. EBITDA down across the board, and then current value kind of flat on the equipment side, and then down a little bit on the event side. Dan, any comments on revenue? I know you were talking about EBITDA here before we got on, and then also I would ask, a little bit on the value.
Yeah. So, the big shock for me right now is how much EBITDA is dropping off in both industries, being affected, and we're going to get to that, why it's dropping off. But so Charlie, I'll just kind of say like, hey, we're recognizing there is a drop in EBITDA, which means there's a drop in value. You're going to find out more about the impact of H&E because of the impact on the M&A and whether the multiple stays up there, right? Because I'm anticipating a drop in the multiple, perhaps, believe it or not. So there's a lot of potential negative that we're waiting to see come out of this. But I think it's just one of those times for the industry that we all got to buckle down and look at ways to improve efficiency and reduce expense.
Yeah, well, and I will make note that the equipment and event multiples last year were both at 5. So even going from 4.5 to 4 has been a shift there as well, right?
Yeah, I mean, we're getting reports. So just so you know, we have new affiliations with TM Capital and Catalyst, and both have state of the industry reports, which include the multiple. We also have, from our own valuation tool, we have the ability to back into what the current multiple is. So as that shifts, we'll let you know. But again, unrelated to financial performance, more related to the actual value of your asset, which is your business.
Sure. Yeah. Okay. So moving forward, next I'm going to cover a little bit on people productivity. So for most of us, people and labor is our most expensive driver in this industry. So the number that I've pulled out here is the revenue per employee hour paid. So this is looking at everything. So this is your true cost of labor. So your paid time off, vacation, holiday, all those things getting wrapped up into this number. So you can see the equipment performs a little bit better than the event, which we would expect. And then you can see that those numbers are relatively flat. Event is up just a little bit over previous year.
Hey, Charlie, one other thing I would make a comment on, go back to the revenue slide, the previous slide.
Mhm.
So when you're seeing these revenue numbers, you might be a little flabbergasted at what you're seeing from the event rental side. And that is because we're attracting inside the peer group network, we're attracting the larger independent event rental.
Correct. Yeah, than what we've had in previous years.
Correct.
Okay. Gross margin per employee hour paid. So this is backing out your rental costs and putting that to your employee hour paid. You can see here on the event side, it's gone up a little bit and then kind of neutral for the median. And then total labor as a percentage of revenue. Like this is the one, right? Like if Dan always uses the adages, if there's one number that I could pay attention to, right? Like this is it, right? So total labor you can see is kind of flat. I'm a little bit surprised that that's flat, I guess, because we hear so much of people talking about how they're having to pay employees more. The cost of labor feels like it's going up, but the numbers so far, are kind of flat. So
yeah, we took the hit in 2023 data, and
okay.
then 2024 was kind of flat with 23. Because remember, the pain we all felt in 23 was a different kind of pain than 24.
Sure.
Like they were, we were actually having we had better success with some employee situations in 24 than we did in 23.
Sure. Okay. Well, so do you feel like the pricing and the cost of labor is kind of flattened out then?
It could have been, yes. I think the key is going to be, again, what are you doing with your staff on the event side? We talk about, whether you're going to embrace tent and make tent, continue to make tent a big part of your business because of the labor costs associated with tent, right?
Yeah.
So we do see people a small amount of tent getting out of it, moving more into event. On the equipment rental side, it goes back to the old adage, bigger contract, bigger duration on contract.
Sure.
Right? So
yeah,
it's going to reduce your labor costs as a percentage.
Sure. Yeah. Okay. And then I'll come to those in just a second. The next one that I want to talk about is asset productivity. This is very popular on the equipment side. Guys are looking at dollar utilization, time utilization, all those kinds of things as they on the equipment side, especially. Um, Dan, on the event side, it just doesn't seem like that number floats around. Like from an event perspective, what do you feel like those people should be paying attention to as far as assets go?
I think it goes back to, if anybody remembers me talking about the grid of high dollar utilization versus low dollar utilization, high time utilization versus low time utilization. So if you build out that grid, and we can talk about, I think we've recorded it, we might be able to push it around to you. But the idea would be, I'd be looking at that, trash or trash to cash,
Yeah,
try to categorize those assets, looking at your inventory and making a decision to get out of certain things. And even if it's small cash, you're moving it into a more productive space. But dollar utilization, it typically, based on what's captured in terms of rental assets on the 10 side, dollar utilization is like over 100%, which
yeah,
doesn't make a lot of sense, right? So
right.
there's a lot of rental assets that are expensed and never get captured.
Yeah,
You hope that in the management software they're capturing it.
sure. Yeah. Well, and also maybe it's walking through the warehouse and seeing what's dusty.
Correct. That's another way to do it.
Right.
But real quick
Okay.
comment on the dollar utilization. So for equipment, so these are very high numbers.
They're even higher than
So
last year.
So just to be clear, what you should be looking at is, what is your inventory mix? So if you have things like lifts, whether they're scissor lifts or articulated booms, you're not looking for these types of utilization numbers. If you do, then good for you. But
Right.
reality is that we have a number of 10, $20 million operators who are very comfortable with a 40% utilization on some of the big pieces, right? So I
Yeah.
think you just have to consider what type of business you are. Are you focusing on a homeowner market, or are you looking at heavy construction? You're going to set your goals, and then you're going to try to go towards your goals. So you'll have your own model. So even though we have benchmarks around averages and medians, always talk to your facilitator about setting your own goals for your company.
Yeah. Well, and when I'll just jump ahead to this next slide because I think that can kind of cover some of that here. And then also is probably a good plug for Rouse because they can kind of give you those numbers that really drill into your, whether it's your point of rental, alert, rental man, Quickly, whatever software you're on, it can work with that to kind of, drill into those numbers on a much more, specific basis, right?
Yep.
So here we're looking at kind of what we've seen on the inventory mix, and my next slide will cover the event side, but this first one is on the equipment. So you can kind of see here's just a where the revenue is coming from. So 14% from aerial, 40% from dirt, and 47% from other. So there you can see, somebody that's, probably heavy in other is going to have shorter term contracts. Stuff's turning more often. They're having to touch it more often. Whereas on the aerial side, stuff's going out for, months, even sometimes years at a time, and you're short of sending a service truck out to look at it, you don't have a lot of costs associated with that when it's on the job site. And then revenue by customer segment, same kind of thing there, right? A contractor, is a little bit less cost associated with serving the contractor versus a homeowner. Homeowners are probably looking at, 4 hours to a day on something where you're handling it, kind of turning it, maybe even turning a piece of equipment multiple times a day, versus a contractor where you've got, kind of, stuff that's out longer term. So for you guys, especially in the, as you go through your meetings and you're talking with the other members in your group, kind of understanding what their business looks like compared to yours, it can really give you a better way to compare. It might not be realistic for you if you're in a homeowner market to try and compare yourself to someone that's, really focused on contractors and that kind of thing. And your numbers are going to be different from that perspective. So, any comments on this slide, Dan?
Nope.
For the first time. All right, so then moving on to event, and this is very similar, right? So on the event side, we kind of break it down between tent and event. Obviously, tent being, more labor intensive, whereas event might not necessarily require the heavy labor that tent does. And then also the other, we're seeing a lot more, I don't want to really call it site services, but that, the kind of the bigger picture stuff is starting to come up on the event side, whether that's restroom trailers or fencing or, all those kinds of things that kind of go along with this stuff. We're starting to see more of. And then revenue by customer segment, again, the consumer, that's that backyard graduation party, small wedding, that kind of thing. Whereas the corporate and institution is more of that business to business client versus the backyard wedding. This is the person that, you're delivering 1,000 chairs to for a weekend and that kind of a thing. So obviously you can see the costs associated with those types of events are going to be much different than, the costs associated with a backyard wedding and the labor related to those. So that covered all that time too, Dan?
Yep.
Moving on. Okay, sales mix and gross margin. So again, here we're looking at, you can kind of see some of the gross margins related to the sales mix. So this is looking at where the revenue comes from. So you can see a majority of our members are strictly focused on rental, especially on the event side. Majority of their business, if not all of their business, is coming from rental. On the equipment side, you can see we do have a few, we do have a little bit of new equipment sales getting represented here, maybe whether that's a small dealership or even just, when you go to the trade show, instead of buying, 3 compactors, you're buying 6 and you're selling 3 of them on the showroom floor. Supplies is more related to, kind of what goes out with the rental equipment. And then the other just kind of, that's kind of the catch-all, parts, service, other stuff there. Dan, have you seen any shift in these numbers? I didn't color code them because it's not really appropriate, but have you seen this change?
The one comment I would make is we wanted to make sure we had 24 data. So there will be some more submissions and we will see equipment pick up. I can't remember what it was last year. I'm going to guess it was closer to 20% of all revenue. So, the initial early groups don't have as many dealers in them, but there are going to be some that are going to pop up and that'll become bigger. And again, everybody knows that depending on what your pie chart looks like for your sales mix, it's going to dictate your overall gross margin as well as your overall EBITDA. So when we see people struggling inside of the group to compare with their peers, we say, don't get too crazy about it. Make sure you look at your mix of work versus the people that are in the columns next to you.
Yeah. Well, and for me, one of the things that I always liked about reviewing the composite book with the group was you had that opportunity to have the conversations with different people of, why is your number different here compared to mine, or kind of having that back and forth about, well, whatever the case might be, right? So I think that's one of the great benefits versus just seeing this on a spreadsheet, right? Being able to have the conversations with the people behind the numbers.
People are going to want to focus on the top quartile, which we call Top Gun. And you may recall the last couple of years we've issued, it's called Top Gun for hybrid and Top Gun for homeowner. And again, that's based on the fact that either you've self-designated as a homeowner or we've kind of figured out that you're open on weekends and you're doing stuff. Um, and then for hybrids, we look at if your rental is 60% or less. So if rental is 60% or less, because we have building materials companies submitting, we have lumber companies submitting, we have hardware companies submitting, we have Bobcat dealers submitting, so there's a whole bunch that go into the hybrid Top Gun. They're never going to win with a 40% EBITDA, right? That's strictly for the straight rental operators that are going to hit those types of numbers.
Sure. Yeah. Okay. Any comments around the gross margin numbers, Dan? You can see it looks like the event has improved a little bit. Equipment down a little bit.
Not really any comments. Just everybody should be aware that in the past, we would take depreciation of rental assets as well as interest related to financing of rental assets as a cost of labor. And we don't do that the last 2 years. So we've been pulling it back out, putting it below the line. And there's a lot of reasons why that has changed. I'm not going to get into that right now, but it's important for us to know that these are the numbers right before, or did you add them back, Charlie? Are these the ones
these are
before? Okay.
straight out of your
Straight
deck you
out.
sent me.
Okay. Yeah. So these definitely are a little concerning. It means the rental costs associated are up a little bit. I'd be looking at repairs and maintenance and delivery costs and driver costs and all. Well, drivers shouldn't be up there. There also could be a significant amount of contracted work and or outsourced. So if people are trying to grow with that type of strategy, you're going to hurt your overall gross margin. So just be aware of that.
Okay. All right. Well, do you feel like people have gotten better about attributing costs that maybe before they were tracking below the line that now they've moved above the line? No.
And I don't know.
Sorry, I didn't prep you for that one, right?
No, I was just thinking like I didn't want to open a can of worms because there's an argument. There's a huge argument that says we can definitely identify employees tied to the activity of rental. And so
Right.
based on that, we should really be looking at, putting them up especially if we're sub renting and we're doing all those things. And in the case of event rental, people leasing
the
vehicles,
temp labor, right?
renting trucks, all that kind of stuff. That's all part of the cost of doing business, cost of goods sold, cost of sales.
Yeah.
And it's not perfect, but right now we have all labor costs down below the line. So anyway, sorry.
No, that's all right. That's good. But I think that's important to have those kind of conversations, right? Because you kind of understand, talking about it and feeling out what, kind of what stuff goes where is important. Because one of the things that, as I was preparing for this and one of the kind of things that I was reading was that financials and that is, it's a little bit of, not only is it data and numbers, but it's also a little bit philosophy, right? Like different people have different ways of categorizing things and all that kind of stuff.
I mean, and one of the best, epiphanies the last couple of years was we started asking people on the forum, at what level do you depreciate a rental asset?
Yeah.
Because that makes all the difference in your EBITDA. So we had some people that will depreciate everything over $100, or they'll capitalize it. I'm saying, sorry.
Sure.
They capitalize something over $100, whereas another person says, well, we capitalize everything over $7,500.
Yeah.
Well, obviously the one who capitalizes at $100 is going to have a great EBITDA. They're going to get Top Gun for the 4th year in a row, right?
Yeah.
And so we need to be aware that, making that choice has an impact on how it gets represented.
Yeah.
So that's why we ask for it up front. So
yeah. No, I remember back in the day, we were at a point where we were capitalizing everything because we had an audit at one point. So like every single freaking screwdriver got capitalized. It was crazy.
One other comment is we have not had a CFO summit for about 2.5 or 3 years now.
Prior to COVID, right?
That really was a great equalizer. We'd get so many people involved from a summit standpoint to address these issues.
Yeah.
And we just haven't had that. So we need to like consider what will it take to get a CFO summit going again.
Yeah. Yeah. We got some heavy hitters on the call. I'm seeing Sharia's on here. She's got a lot
Oh,
of
cool.
experience in that.
Yeah.
So,
She's
yeah,
like
that'd be a good-
salivating right now. She's like, bring it on. Bring it to my
Right.
town so I can facilitate it.
Right. I'll go to Arkansas. Let's see, expense management. Okay, so some of the comments around here that that Dan made as I was presenting this is how they've been so similar for so many years. And then also with these, just keeping track of them and looking to improve them, whether that's month over month, quarter over quarter, year over year, all of the above, because a lot of these are not going to get less. They're all going to go up. And if your revenue's staying the same or not keeping up, it's going to kill you. So,
yeah, just real quick comment on
go
the
ahead.
so I'm comfortable with where the personnel is coming out. I will say that the occupancy for equipment will go up. The initial group that submitted data had managed their rent structure and some of the ancillary utilities expenses. So I feel occupancies on the equipment side is going to end up around 8 or 9%.
Okay.
It will be down because what's happening is we're seeing more revenue per square footage, more revenue per acreage happening. There's no question that that's definitely a trend. And so that's why I'm saying occupancy on the equipment side will probably end up around 8 or 9.
Sure. So let me just ask you a question on the personnel side of things. So I've had a couple conversations with people recently around fractional services, outsourcing, those kinds of things. How do our members kind of reconcile? Like, I'll use the example. I have one customer that has an internal marketing person, and so do they count
Yeah.
that salary in the marketing bucket? Do they count it in the personnel? Then when it
Yeah.
comes to discussing it with their group, like how does that shake out?
Yeah, that's a problem. So that is definitely CFO summit type material, right?
Yeah.
Relatively new change in the last 3 to 5 years. I know that my gut feeling is to take that fractional person and put them into the operational category. So right now, like we had a marketing person costing us 50 grand a year. We went to a marketing service costing us 32 grand a year. And when we had the employee, they were in overhead wages. When we had the marketing service, we put it in
Right.
marketing. We said this
Yeah.
part of it. So, it's just, I believe that the gut move by most of our members will be to put them in the operational area.
Yeah.
The one thing that I can say is always 50-50 split is fractional bookkeeping, accounting, CFO
Yeah.
activity. So
Yeah.
it's always been split. If you have the employee that goes into, obviously overhead wages, if it's a fractional service, lots of times it'll end up in professional
Yeah.
expenses. And
Sure.
right now, that's just the way it is. So we are seeing that operational expense go up. So even though it's red and yellow, operations was typically 10%, occupancy 10%, personnel 30%. That made up the 50% of overhead. And that was for decades,
Yeah.
30, 10, 10. So you're seeing it slightly different.
So it's amazing as much as we dig in and look at these numbers, how little the moves are over the
Oh,
years.
yeah. Yeah.
Yeah, crazy. Let's see. So this next slide just kind of digs into the operations a little bit, looks at marketing, education, professional. That there you can kind of see the professional that Dan was talking about, ops and vehicles, and then kind of the admin
One
side
quick
of this.
comment. One
Go
quick
ahead.
comment on this. I know we're not really making a point to promote the median over the average, but I want everybody to know that I always promote the median over the average in terms of a benchmark. The middle,
Sure.
the median is the middle. It gets rid of the outliers, whereas the
Sure.
average, it never gets rid of unless we did some kind of standard deviation and were to get rid of some of the outliers. It's just literally an average. So you're going to have
Sure.
some people are going to be really high and some are going to be really low, and you're hoping that it averages out.
Yeah, well, in the median, I like the median because I always thought of it, you're taking to everybody and you're lining them up in order, like, you're
Yeah.
sorting ascending or whatever, and then you're picking the middle, and then you want to be on one side or the other of that
Correct.
number,
Yep.
right? So it makes it easy. So yeah. So the one of the things that I did notice on this one was with the admin is the some of the things that we kind of considered in that. I feel like on the event side especially are getting passed on to the customer. So for example, the credit card fees, some of the permitting and stuff that maybe back in the day you were just kind of doing to do it, whereas now that stuff kind of is getting passed on to the customer. I think we're starting to see more of that. So maybe some cost recouping happening there a little bit.
Yeah, I think the administration expense is going to be an area that we've got to really keep an eye on. I'm seeing like incredibly bizarre submissions around that. So, just everything from, low end 1.9, which is what we have seen in the past. And then on the high end, we have some people submitting admin expense in the 15 to 20 range, which just doesn't make a lot of sense. So.
Yeah, that's a big swing.
Yeah.
Okay, debt management. So this kind of gets past the kind of the day-to-day operations, right? And now we're looking at more of the health of your business and the cash coming out of your business, the kind of the more of the balance sheet kind of stuff here where we're kind of taking and mixing the two together here a little bit. So the first one we're going to talk about is debt service coverage ratio. So this one is really looking at your ability to pay down your debt. And Dan, I'll maybe kind of ask you for a little bit of clarification on this. But it was looking at your net profit divided by the long-term debt. But then also one that I read was looking at more of your debt service. So like what you have in payments and interests in a particular year or a period of time.
Yeah, just briefly on that. You actually have it written here as net profit compared to long-term debt. And I actually reported the data from EBITDA compared to long-term debt.
Okay. So I'll change that before I send this out.
Well, I was going to say we can have a conversation afterwards as to what is most useful, right? So whenever you're using EBITDA in lieu of net profit, you're really talking about a performance data point. If you're using net profit, it really is exactly what you said. It's your cash available to pay debt. So I'm thinking that we leave yours correct, leave it there, and then I make changes to that to make it come down, to use the net profit data. The problem is that the net profit reporting is, to mitigate taxation.
Correct. Well, and that was one of the things that it said in my reading is that, like, going back to that philosophy thing, like you can massage the numbers, right?
Yeah. I look at debt service coverage ratio when you're looking at EBITDA compared to long-term debt. It really is performance. It's like, our long-term debt is managed and our EBITDA keeps going up. That's great. I have a high debt service coverage ratio. Good for me, right?
Yeah.
So so there's something to be said for leaving it alone with EBITDA. So anyway, I'm thinking and talking at the same time. But anyway.
No, that's all right. That's good, right? You guys are seeing how the sausage gets made here. All right. And then the next one, leverage, using debt to increase your growth here. Yeah. So looking at your revenue divided by your long-term debt.
Now, real quick,
go ahead.
Comment on that is, and I get very frustrated with, you need to identify what stage you're in. So if you're in growth stage, then don't get all proud about the fact that you're paying off your debt. I hate that. It makes me so annoyed. Don't show me that you have no long-term debt. You're in growth mode. You have to fuel it. Your return on asset, your return on equity is great, comparatively speaking to, I don't even care if the interest rates are up. Like, are you kidding me? Take on more debt, buy more stuff, make more
Buy
money.
more stuff
right?
as long as it's going out the door, right?
So the leverage number really does have a lot to do with whether you're in growth mode or not.
Yeah. Yeah. So speaking from that perspective, what kind of numbers? So is there a number that you can say if you're in growth, you need to be at this number versus if you're in mature, you need to be in this number, or is it just kind of higher and lower?
I would say, again, if I had a rental operation, I want to be in the top quartile of leverage because
Yeah.
otherwise, what am I doing?
Yeah.
Right? I'm just basically saying, we're not very good. We don't really make a lot of money. I put half my money into the stock market and half my money into my company. It's
Well,
like
so
I
when
want to
you
be in the
say
top
that,
quartile.
that return on equity, that was one of the things it said was that you could use this number to compare to the S&P 500 over time to see if your business is giving a better return than what you would if you put it in the stock market.
Right.
Right.
Yeah. All good indicators, right? So when you get your summary page in the composite book, you've got asset productivity, employee productivity. You're seeing like some key data points. You want to know, is my data in the top quartile?
Sure. Yeah. So thinking about us using this data internally or within our business, what is like an external person? What are they going to be paying attention to in these numbers versus
Um,
what we might use internally? Does that
like a
make
bank,
a
like a
bank
bank.
or an investor or maybe somebody that's looking to buy? Like I'm probably opening a can of worms here, but I'm curious.
No, I mean you're onto something there. I think clearly debt service coverage ratio is something that's brought up. And in fact, in this day and age with Google and AI and all that, you can pretty much, ask AI, hey, what does a banker care about when it comes to a small business lending opportunity? With a business owner. So, we have the chat rooms going on WhatsApp and GroupMe, and there's just tremendous conversation happening around financing, but at the end of the day, like you have to be the educator to your banker. If
Yeah.
we had somebody working with Bank of America forever, and I'm like, what? Are you not testing the waters with your local and regional? Because if you do get somebody aligned with you, then you're in good space, especially if they're a decision maker like a bank president or something like that.
Sure. Right. Yeah. Yeah. Okay. Let's see. Okay. Then liquidity here again, right? This is looking at cash. The current ratio, I always liked this one. It made me, felt like for every dollar that I had in the bank, this was the dollars owed, and whether that's too simplistic or not, but it was kind of an easy one for me to kind of wrap my head around. The next 2 days sales outstanding and days payables outstanding, these ones I always, kind of had a hard time wrapping my head around. But it's your ability to pull cash out or the opportunity for your bookkeeper to collect faster and pay slower, right? So that you're sitting on that money a little bit longer. And again, that current ratio, is that something banks and externals are looking at, do you feel like?
Oh yeah, I think anybody like and especially like you think about Sherry on the call here. So she works with a number of members, and I'm sure Sherry, you're probably having conversations all the time about cash flow management. It's the first step to really looking at your cash flow statement and understanding, what matters, what's important. Again, the key for me is to not have this data get too high. In other words, it's good to be green, which is you have more current assets minus rental assets divided by current liabilities, but at the
Sure.
same time, you don't want to have 7.
Okay.
You don't want to be like some crazy number where it's clear that your money is not working for you.
I got you.
Right? You're parking it. Now, if you're going to sell in the next 5 years or something like that, you're just in a state of maturity, then
Sure.
I understand all that. Like I get
Yeah.
what you're doing. But if you are growing your business or trying to grow your business, then you need to be smart about your liquidity as well.
Sure. Yeah. Yeah. Okay. Well, so that is my last slide on kind of what we use within the composite book. Any other things that, and then I got a couple others that we'll cover, but any last comments on, kind of specifically what we pull from the composite book, Dan?
No, but I would say to the event, people on the call, please don't take 76.57 days to pay your expenses for a meeting. That would basically put us out of business. So I'm not sure, but I don't think that's happening, obviously. I'm joking. But
Well, and that's kind of, I mean, it's funny that you say that, but like that's always the thing that I struggled with these ratios is like, I know I pay my bills faster than 76 days, right?
That's a good point. So this data is not accurate, FYI. So days sales outstanding and days payable outstanding, you can see the calculation there. We're doing the best to give an indication of how fast you are collecting and how fast you are paying out. That's all it is. So it's not like literally, oh, we're collecting every 15 days and we're paying out every 64 days. But
Right.
it's relevant, especially if you look at it versus last year or the year before,
Yeah.
and so forth, so on.
What
And
about like looking at it through the course of the year? Like looking at it each month or no?
well, again, if you have seasonality in your business, certainly
Mhm.
you could see that
Yeah.
thing move. I love it as, we're a lot of EOS people here, a lot of traction people here. I
Mhm.
love it for the financial department of your company to have key metrics.
Sure.
This is a great way to know, is your payables and receivables people, your bookkeeper, are they doing what you want them to do? If you make a change in that area, this is a good thing to say, what was it before? What was it after the change?
Oh, sure. Okay. Yeah. Okay. That makes sense. Okay, so then the other one that most of you guys are probably familiar with and is the rate of change. So this is just kind of I kind of think of it as the quick and dirty one, right? Like you track your monthly revenue, and then it compares your month over month, your quarter over quarter, and your year over year. And then we plot that change on a graph, and you can kind of see the different phases of growth that you're in, right? So the A phase is you're below zero, but you're getting better. B is above zero and getting better. C, you're kind of plateaued out. You're still growing, but at a slower clip. And then phase D is where you're to the point where you're getting smaller and at a faster clip. So, and all of these phases within the spreadsheet that we can provide give you, kind of some business activities, I would almost call it, to be thinking about and paying attention to. If you're in a phase B where your business is growing, you're looking to expand your capacity, add inventory, bump up your staff, all those kinds of things, so that you can kind of ride that wave a little bit. And this is a good, just kind of an easy one to use. If anybody doesn't have that, please feel free, send me an email. I'm happy to get it set up for you, and get you going and getting in the habit of looking at it on a monthly basis. Any comments on rate of change, Dan? Been using that one for a long time.
No, I think it's great that everybody's looking at it. It's good.
Yeah. And then this is where I want a little interaction and a little chat feedback. I want to know what you guys are looking at. What other KPIs are you using? It's great to have that financial aspect of it and to consider your financials on a monthly basis and quarterly basis. But it's also good to give your staff and your people a number that they can kind of pay attention to. Dan mentioned the EOS world and traction. We talk about everybody's got a number, right? So this is just kind of some of the ones that I've kind of seen over the years, of ones that are popular. I'd be curious if you guys have any others that you like or that you feel like are important within your business. Throw them up in the chat and we'll throw them out here. The one I really like, especially on the counter, is the average contract value. You guys probably get tired of me talking about it. But that's a number that your counter people see every time they send out a ticket, right? They know what the dollar value is on that ticket, and it's an easy one for them to kind of have an impact on, right? So, Dan, any others that I missed, or any others that you like from an operational perspective that you think people should be paying attention to?
Let's see. No, these are good. I like them.
Well, and the reservation value, that's huge on the event side, looking at what they have on the
Yeah.
books for the next 30, 60, 90. One of the ones that I have kind of heard recently was on the mechanic and yard side. We look at, when I was at Bobcat, we really paid attention to the work orders and how old a work order was. But the other one that I really like is the dollar value down, right? Like we look at pieces.
Yeah.
Maybe we got 100 pieces that are broken, but if it's a, $500 sewer auger that never goes out, like who cares compared to a $40,000, boom lift or scissor lift or whatever, right? Like the stuff that's moving every single day, I think is another good one to pay attention to. So,
No, it's a good slide.
Brenna, anybody giving up any good data in the chat? Are they all holding back, keeping them for themselves?
Everybody's holding out today. Just kidding, but
What about Phil Gatella? He usually has good stuff.
Right? Yeah. All right. Well, and this is my favorite, right? Like we're all talking about the slide you saw at the beginning. I created that slide with ChatGPT, and so I had to create another one that is we talk about numbers and knowing what's going on and that kind of thing. There's still something to be said for the guttometer and the banko gauge, right? Like your intuition as a business owner and your feel for your business is, it I'm not gonna it can't be replaced with numbers, right? Like the numbers are gonna back up kind of what you're feeling within your business and your experience in the business. The one thing that I don't have on here is, when you walk in the morning, is the phone ringing. I forget if it's in Traction or if it was in an EOS meeting where, the business owner heard the phone ringing and, 2 rings was good, 3 rings was bad if it was still ringing after 3 rings. So those kind of things are still important, indicators for the performance of your own business. And then one other thing I did want to share with you guys, and again, we'll send out this this slide deck, but some other resources. I graduated with a degree in accounting, but I still find myself going back to accountingcoach.com. It's a really good resource. It kind of breaks down the different financial statements, whether that's the income statement, balance sheet, statement of cash flows, all that kind of stuff is on there. Investopedia, Dan put me onto this one. It's great because it has a great not encyclopedia, glossary. It's got all kinds of different terms and stuff that are on there. If you've got a question about, a particular ratio, or you're not sure what good looks like or that kind of thing, it's really got a lot of good stuff on there, and unless I haven't clicked enough, it all seems free. So, and then the SBA does have a little section on small business financial acumen that's out there. And then the other article that I found and really liked was 6 lessons for small business owners that Forbes had out there. So, there's a lot of great resources out there. Especially within your peer group. I know each group is a little bit different, but there's definitely people within each group that are, kind of the numbers person within the group, whereas, maybe there's another guy that's more the sales guy and he's, not necessarily tuned into the numbers and able to help. But and then also, just lastly, I'll say, Dan and I are both here to help. If you have any questions, feel free to give us a call. Happy to answer any questions or help with anything, and if I'm not able to help you, I'll certainly find somebody that can. So any other questions before we end it here?